If your fixed rate ends in the next 12 to 18 months, this is the exact point where good decisions quietly get made, or expensive ones sneak up on you. And most people do wait far too long. What most people think is, I'll worry about my mortgage when the deal actually ends. But the reality is very different. By the time your fixed rate finishes, the best decisions should have already been made, and now they're missed. In the 25 years that I've been helping people with mortgages, the biggest regret that I hear isn't about the rate they choose, it's about not starting early enough. If this were my mortgage, the first thing I'd do is get really clear on my own position, not what the market's doing. I'd look at four things straight away. What my mortgage balance will be when my deal ends, what my property is realistically worth, what my job and income are likely to look around 6 months before the rate expiry, and I'd take a proper first look at my credit profile. Now that last bit is important because lenders don't assess you based on how things look today, they assess you based on how things look at application time. So take a good look at your report and tidy up anything that needs it. Outstanding balances, missed payments, old accounts, address history, because small changes here can have a huge impact on the deals that you're offered. Understanding those four things early tells me my true loan to value, affordability, and lender options, which quietly controls what rates I'll be offered. Second, I'd plan 6 to 9 months ahead, minimum. Most lenders allow you to secure a rate well before your current deal ends, and that's generally around 6 months. That gives you a safety net, it's not a commitment. But before I did anything formal, I'd revisit my credit profile again to see how it's now looking. If there's anything left that needs tidying up, get onto it straight away. And now is also the perfect opportunity to start tidying up your bank accounts. Try to get out of your overdraft if you're using one, clean up your spending, remove things that you don't need to spend, and start trying to clear outstanding debts or saving. Generally, tidy up your spending and bank account to make your life and bank account look as simple and straightforward as possible. This isn't about perfection, it's about removing avoidable friction before it actually matters. Now once that's done, then I'd look at securing an option early, knowing that I can still switch if rates improve. And third, I'd stop assuming that my current lender will look after me. When a fixed rate ends, you don't get rewarded for loyalty. If you do nothing, you drift onto the lender's standard variable rate, and that's where mortgages quietly become very expensive. Doing nothing is still a decision. It's just rarely the right one. Now, I regularly see people who could have secured a strong deal months earlier, but they waited because they thought they were being patient. Then affordability shifts, or criteria tightens, or life changes. And suddenly the choice isn't what's best, it's what's left. And that is never the best position to be in. So if your rate ends in the next 12 to 18 months, this is what matters. Start reviewing things around the 9 to 12 month mark. Know your numbers early. Treat an early offer as a backup and not a final commitment, and make decisions from a position of control, not urgency. This all applies no matter who you are, high or low income, good or bad credit, moving home or remortgaging. The same rules apply, being prepared is key. You don't need to predict interest rates to get this right, you just need time on your side. So if your fixed rate is coming up, the smartest move is simply to start the conversation early, even if no decision gets made yet. That's how you stay in control of your mortgage rather than reacting to it.